Welcome back to the Value Investors Club. I'm your host, Simon Wunderlich. Let's get right into it with VIC readings, the format where we look at the best recommendations of the best value investors. Today, we have Deckers Outdoor Corp, DECK, filed on October 21st by Surfer. The price at that time was $363. Description: Deckers owns and operates a portfolio of footwear brands including UGG, Hoka, Teva, Suanuk, and Kula Bura. UGG brand, $2 billion LTM sales June 2020, with a 55-45 split between wholesale and DTC. Hoka brand, 1 billion LTM sales with 70-30 split between wholesale and DTC. Hoka and UGG together represent 92% of DEG revenues. Hoka launched 7 years ago and is known for its authentic, highly cushioned, high performance running shoes. Revenue grew at a 59% CAGR from fiscal 19 to fiscal 22, March 22 year ended, underscoring the significant growth and brand heat over the past few years. While growth will decelerate over the next 3 years off a higher base, I estimate the brand can still grow at a healthy 35% CAGR through fiscal 25, with DTC growth outpacing wholesale growth, which is gross margin accretive. The market remains underpenetrated both in terms of total TAM potential within just the running shoes market and underpenetrated from a wholesale distribution perspective as well. Running shoes is $11 billion market, of which Hoka sales represent a 9% share. Other athletic footwear, cross training, gym, fashion is an additional 10 billion market that the brand can penetrate over time. The majority of growth over the past 2 years came from market share expansion within existing specialty outdoor retailers. Increased order book, new product launches versus opening new points of distribution. As of the first quarter 23, Hoka was still in less than 20% of DKS stores, with FL distribution just launching. In addition to expanding toward non-running specialty wholesales, international and DTC brick-and-mortar stores present growth avenues as well. UGG growth stagnated for a few years around fiscal 16 and 17, and the company subsequently implemented a segmentation and allocation strategy in the second half 2018, wherein it rationalized distribution, exited foreign doors in the US while adding select premium partners, and began diversifying its product lines. The company undertook a similar restructuring in Europe, which was largely completed by end of calendar 2021. As part of the process, UGG exited 20% of wholesale accounts, localized marketing, and reduced the brand sales reliance on core classics in the region. UGG wholesale operating margins, pre-unallocated corporate, improved 34% in fiscal 19 versus 27% in fiscal 16 of a similar revenue base. The brand also martially and diversified its product line away from the core classic boot, both within women's footwear and via launching men's, kids, and apparel lines. Brand revenues grew at a 9% CAGR from fiscal 19 to 2022, within 13% and 15% growth the past 2 years, as the brand was a beneficiary to some extent from the pandemic trend toward casualization. iModel sales roughly flat through fiscal 25, 1.3% CAGR, though I think there's upside potential to this estimate as LMSD is possible as some percent of customers acquired over the past few years stay with the brand. That said, I believe ARC stabilization, not outsized growth, is all that is needed for the stock to work if Hoka can continue to execute. While the first quarter 23 inventory levels increased sustainably year over year, it's worth noting that the last year's inventory was below normal operating level given significant supply chain issues. Factory shutdowns in Asia, port congestion, logistic issues. Additionally, given longer lead times early in the year, which have started to more normalize as of late, the company ordered fall and winter product earlier in order to ensure it would be able to meet demand. The company is guiding for Hoka revenues to grow in the 40% range for fiscal 23, and I expect actual results to come in above that for the full year as demand remains strong. I expect F23 EPS to be in the $19.50 to range $20 range versus a guidance for 17.50 to 18.35. I think F24.25 street revenue EPS estimates are too low. I think the company can do $23.5 EPS in F24 and close to 27 in F25. 52.2% GM percent by F25, which represents modest expansion from baselines as DTC penetration increases and air freight costs reverse. Plus, SG&A margin flat at 33%. Dollar growth in line with revenue growth as the company continues to invest in marketing to grow the Hoka brand. This includes the impact of 10% share count reduction as the business generates substantial free cash flow that can be used toward share repurchase. 1.5 billion repurchase authorization as of first quarter 23. $27 EPS at 20x PE, 18% EPS CAGR from F22 to F25 equates to a 2-year price target of $540 or 50% upside from current levels. Catalyst, earnings growth, upward revision. Thank you very much for tuning in.